We recently saw gold reach an all-time nominal high of $2,140 an ounce. Although adjusted for inflation, it still has a way to go. But there is one thing that's driving that price action other than that one night when we saw it spike up so dramatically over the last few years. We're going to talk about why it is going to happen again in 2024 as we explore. Say what you want about precious metals, but gold and silver have done pretty good, all things considered, especially with what the Federal Reserve has been doing, raising rates as high as they have and for as consistently as they have. In fact, they are keeping them right where they are at. As you watch this video, more than likely, the Federal Reserve has made action again to not raise rates. In fact, I'm reporting this before that meeting is over and before that decision is made, but I can say with pretty good level of confidence that they're not going to raise rates. But nonetheless, gold and silver are reacting to what the Fed does, even to what they say they're going to do, or just talk that they give about the markets. That's how much power the Fed has. And the markets move based off of what they say, and that includes gold and silver. But the overall premise of what gold and silver do and the power they have extends far beyond what the Federal Reserve does. In fact, how do we know this? Because there's other central banks around the world that are actually buying gold now. And that is the thing that I think we must take into account, and that is the biggest reason why gold is going to continue to rise in 2024. It's also part of the reason why silver is not moving as well as gold. And for the same reason, and I think that's just it. Silver is seen more as a commodity these days than as a monetary metal. Central banks don't store silver. Now, there are some stockpiles that governments may have of silver for certain military uses. We've talked about that on this channel as well, too. The United States government very well could have a strategic stockpile of silver again that they're not telling us about. You never know. But one thing is for sure, silver will remain volatile, and it's kind of a mixed bag. And that's the way it's been for a while, which is why the ratio between silver and gold has been so high over the years. But I still believe in silver, and I think it's a metal that is good to stack because I think it's undervalued. But I want to also draw attention to gold, especially in 2024, because I see gold as a more safe and stable store of value. So in other words, if you are risk averse in the precious metal space, gold might be better for you in that arena. If you are okay with volatility, and even if you just practice straight up dollar cost averaging, I think silver will be fine to accumulate in 2024 as well. But nonetheless, I believe we're going to see more steady upside for gold in the coming year. Now, this is not going to be the opportunity that I'm going to take to give you my prediction on where the price of gold is going to be, but I'm going to be referencing a piece here that talks about what's going on in the central bank space. This is a website here called the Official Monetary and Financial Institutions Forum. And they essentially are an independent think tank for central banking and also for economic and public policy investment. They're supposed to be a neutral platform for public and private sector engagement. And they have a piece out here that talks about central banks and essentially their revival of gold. And this piece here, I think, really lays it out fairly well as to what's going on in the minds of central banks out there, if they indeed do have minds, but the mindset, I guess you would say, of some of the central bankers and bankers accumulating gold. One of the most significant changes in the world of money has been happening by stealth, really, essentially, rather than through any policy announcement. Gold has regained a solid yet unofficial role as the world's monetary system in a barely noticed gradual process that cannot be overlooked. Now, we've been shouting it from the rooftops on this channel, but this channel is tiny compared to even some other precious metals channels. And of course, obviously, the mainstream media and even alternative media are not really covering this as much as I think it should be. But nonetheless, it is now something that maybe for soon may be unavoidable to overlook. It's a result of several interlinked reasons. The last few years have seen central banks run into gold, accelerated by declining trust in the dollar following Western countries' freezing of $300 billion of Russian foreign exchange reserves after the Ukrainian invasion. The sharp rise in interest rates since the end of 2021 has led to significant losses for worldwide bondholders. This applies not just to commercial banks and asset managers, but also crucially to many internationally operating central banks that acquired large stocks of government bonds in successive rounds of quantitative easing. This has damaged the validity of those government bonds as a core element of central bank reserves. And that's actually a very good point from these individuals, for sure. It's a significant side effect that it's had. Gold holding central banks in Europe seem likely to resort to using their gold revaluation accounts to plug balance sheet losses to be unveiled in coming years. They find this as a more palatable option than the alternative, asking their governments to recapitalize them other than a budget squeeze. Another interesting point of view here as we look at how these central banks view these reserves and bonds and the like. Recapitalization would undermine central bank independence by exposing the need for bailout measures. The option they seem most likely to choose, though, could have uncomfortable effects. By demonstrating the newfound monetary importance of gold, which has been slumbering unused in the reserves for decades, central banks could endanger confidence in the national currencies they issue and guaranteed. It could provoke further moves out of fiduciary currencies and into gold by emerging market central banks seeking to emulate the more established European counterparts. We're already kind of seeing that. We've also talked about how other Eastern European nations are starting to accumulate more gold as well, too. Maybe thinking about potentially a move to a gold standard or preparing for such a thing if it were to be an option out of the situation that we are starting to find ourselves in, not only here in the United States, but in Europe and around the world. Now, we know inflation is a big deal, too. And in their latest anti-inflation assault, central banks worldwide have raised interest rates by the fastest in decades, comprehensively breaking the bull market. Since 2020, 30-year U.S. Treasuries have declined by over 50% in value, while shorter-term Treasuries have lost between 10 to 15% on average. Banks' balance sheets have been hammered. 5 U.S. banks collapsed in 2023, the most in 7 years. And that's a big deal, but nobody talks about it anymore, and we could see more. We've already seen several others that have been bailed out at near collapses since then that have been barely talked about, including by this channel. And so with these things that we've got unrealized losses on commercial banks' bond holdings, which have already reached $650 billion. These central banks face unprecedented losses in their bond holdings. Since the 2008 crisis, they have accumulated $21 trillion of assets during a decade-long wave of market support through quantitative easing. As a result of efforts to lower balance rate states, including through quantitative tightening, the number is currently down to 16 trillion from 21 earlier. In the last 15 years, the balance sheets of the Federal Reserve, European Central Bank, and Bank of Japan have risen by 6.5 trillion, 5.8 and 3.6 trillion respectively. Partly as a result or as a reaction to QE-induced currency debasement, many countries, primarily east of Germany, started accumulating gold, as I mentioned before. The rise in the People's Bank of China's gold reserves is particularly noteworthy since it has coincided with a sharp fall in officially reported Chinese holdings of U.S. Treasuries. And we'll be looking at what their intention is, especially how reliant they are on the U.S. economy, if they were to invade Taiwan, and there is a big move away from working with China and trade and also sanctions, well, gold is going to be their only answer other than working with other BRICS nations much more, far more than they are even now, which is likely not going to happen, especially compared to how we are so closely tied to China with manufacturing and outsourcing. According to U.S. Treasury statistics on China's official depository holdings, which undoubtedly understate the level of China's overall treasury investments, China stopped adding to its treasuries in 2014 after the first U.S. sanctions on Russia were imposed in reaction to the takeover of Crimea. China has prioritized alternative instruments in recent years and now owns less than $780 billion in treasury holdings. It's down 40% from 9 years ago. Though these figures do not include dollar investments made via European depositories. Russia has been much more aggressive and sold all of its treasury securities in the last 15 years. A $300 billion asset freeze confirmed President Vladimir Putin's belief that gold was a safer reserve asset. And in the end, really, that is the bottom line. Gold is the safer reserve asset for sure. The extension of Western sanctions across the financial system, which some have deemed dollar weaponization, has given many large emerging market economies an incentive to divert foreign holdings onto gold. And this is seen as less susceptible to confiscation. Brazil, Russia, China, and South Africa, BRICS, have bought almost 5,000 tons of gold for their official reserves in the last 15 years. China and Russia both have added more than 1,500 tons, while India has added around 450 tons. And so it's pretty remarkable and amazing to see how much has been accumulated since 2000 over all these nations. And the United States officially has not added one single ounce, but they have far and above, well above the others, even many of these other nations combined. But there's been a growing amount, and now in 2022, with the record number since 1967 that they've accumulated together, they're getting close to owning more gold than the United States. So we've seen that European countries join the gold rush. I talked about Poland before, adding so much, pretty remarkable, tripled its gold holdings from 337.7 tons in 23 from 102.8 tons in the year 2000. Czech National Bank added a lot, increased by 37.5% in January. The Hungarian Central Bank had similar ambitions, increasing its gold reserves to 94.5 tons in 2021. From just 3 tons in 2018. And again, this is the highest level since 1967 that we've seen in 2022. It'd be very interesting to see what the numbers are in 2023 when those numbers come out. And so it's something that is going to continue, and likely they're not going to sell, but they're going to keep adding. And that means there's less gold on the market, as these central banks account for well over 27%, I think, of all the total above ground gold in their stockpile. That's a pretty big chunk, I would say, and it's enough to have an effect on the price. Now, I'm going to be talking about that in another video as well, too. So stay tuned, folks, to higher gold prices coming in 2024. That's just something that's going to be, as a matter of fact, something we can either look forward to, or if we're buyers, we can lament. Nonetheless, what we know for sure is gold is the answer for the ultimate stability in the marketplace, and it's ultimate money that is stored by central banks and by you and me to preserve our wealth. Yes, indeed. Hope you found this video informative, insightful, and educational. We'd like to extend a multitude of gratitude to each and every one of you for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.